Hi guys, good evening and welcome to Money Control Markets Weekly. I'm Karunya Rao, and as always I'm here to wrap up the week gone by for you and help you make sense of the big trends that are playing out at large as far as the equity markets is concerned. Joining us today is Rahul Arora, the CEO of Nirmal. Rahul, great to have you on board.
Thank you so much for having me, Karan. I appreciate it.
If we look at the markets, they seem to be in a bit of a seesaw mode, very indecisive moves. Nifty has been meandering at 17,500 levels for quite some time now. How can retail investors make sense of what's going on?
Karuna, I think we're in a far better place today than we probably were, say, about 4 or 5 months back. If you remember, crude was around that 120-25 level, and there were some predictions that it would probably hit 150. I think the fact that crude is now currently hovering between $90 to $100 has made life a lot easy for India, both on our twin deficit as far as the currency is concerned. Obviously, there is an inflation aspect that the world is grappling with right now, and I think most central banks are in rate hike mode. But even from that perspective, I think the bulk of the rate hikes are done. I think the economic impact of that is probably yet to be felt. But I think we're probably at the back end of the rate hike cycle. So in many ways, I think the worst of the news flow is behind us. I think the economic impact awaits us. But I think to a large extent, just maybe 3 or 4 months back, the Nifty had gone down to about 15,500, and we have rebounded about 2,000 points or 2,500 points from there. So I think to some extent, some of that did get factored in. I think the retail investor should be very careful in terms of moderating his or her expectations from here. I think for the balance part of this calendar year, we're probably going to be a little range bound. I think 16.5, 17,000 on the Nifty on the way down to probably 18.5, 19,000 on the way up. I think there's going to be a lot of opportunities to make money in this range, but don't expect it to be a runaway rally and I don't think you're going to get into a situation where it's going to be a lot of easy money in the making, but there are going to be opportunities.
Well, you were talking about how we have seen an upswing from June lows, and it has largely been broad-based, especially if we look at sectors like FMCG, realty, auto stocks, BFSI names. But there still was some laggards, the likes of pharma, healthcare, IT, oil and gas. Now, what is happening in these sectors? I mean, why have they not been able to catch up? Is it just the sheer valuations, or are there bigger reasons and triggers at play here?
So I think there are 2 or 3 factors here. I think the first, of course, is when you talk about the IT sector, I think there is a lot of chatter about what is going to happen to the US economy, whether you're going to have a soft landing or a hard landing, and what happens to client budgets as a result of the economic slowdown. I think in our channel checks, whenever we talk to companies or are studying the transcripts of the BFSI sector companies in the US, we get a sense that the total contract value that they have allotted to companies may actually, while those TCV numbers may stay, the implementation will probably be deferred. So I think to some extent, you're probably going to have a situation where revenue growth may not be as robust as you probably anticipated, say 6 months back. And add to that wage inflation, subcontractor costs. So I think you're probably going to get into a situation where margins are going to be a bit under pressure. Let's not forget, Karunya, I think the IT sector was the best performing sector in the pandemic. Stocks did not go up in percentages. They went up 3, 4, 5, 6x. And so to that effect, I think a lot of easy money was made in IT. On pharmaceuticals, I think your point is well taken and well made. That valuations had probably gone a little ahead of themselves basis the earnings that the companies were going to deliver. Some were still grappling with US FDA, some were battling with generic related issues. But I think on a relative basis, I think most pharma companies were probably trading, at par with mean or probably even half to 1 standard deviation above mean. So I think that's probably another aspect of the pharma sector that came in its way was the valuations, very similar to the IT sector. On the flip side, the sectors that you spoke about in terms of the ones that they've done well, I think there's a rural theme there with FMCG and auto. And I think that will probably continue to play itself up over the next 18 to 24 months as we head up to the general election. So I think on FMCG and auto, I would still probably be neutral to slightly overweight. On IT and pharma, probably more neutral to underweight, even as things stand today.
Okay, but if we look at the macro trends and not just go stock specific, but if we look at the big picture, inflation, interest rates, global uncertainty, they're all predicting these business models and different sectors, how they will behave. It's making it all very difficult. So when it comes to investing style. How should investors, retail investors specifically, go about it? How should they go about balancing growth and value?
So if you allow me a textbook response to this, I can probably sort of go back to the basic formula of GDP, which is C plus I plus G plus X minus M, which is basically consumption plus investments plus government spending, plus exports minus imports. Now, as you rightly pointed out, the world is in a slightly uncertain state, so it's very difficult to sort of get a handle on the X and M part. So let's look at the three other components, which is consumption, investment, and government spending. I think the fact that you had 18 to 20 months of a very severe pandemic and people had saved up a lot is what you're seeing in terms of consumption trends play out in India, especially in urban India. And you're seeing this in the volume growth of a lot of companies, including discretionary companies. So I think the consumption leg is okay. In terms of investments, I think whether you look at metals, cement, chemical companies, auto component companies, I think there are reasonable amount of expansion plans being announced even as we speak, even in the fact that interest rates are high, even the fact that inflation is high and margins are under pressure. Companies are still committing to capex and they're still going in there and investing. So I think as far as C and I are concerned, I'm not
But
too worried.
private capex,
Sorry.
but if we talk about private capex, if we look at how private capex is playing out, it's still well below the pre-pandemic levels. Is it
Well,
is it still though a reason to be optimistic?
I think so. I think just let's take a look at Ultratech, right? The massive, massive capex announced by Ultratech not even a couple of months back. You had Novelis announce a near $5 billion capex plan today. You have lots of investments that the auto companies, including the Mahindras, are doing in the EV space. A lot of auto component and chemical companies, each depending on their size, investing 300 to 500 crores. So I think capacities are okay. And I'll tell you one thing, Karunya. When corporates are investing this kind of money, it is only because they have some amount of demand visibility. Otherwise, you wouldn't, as a corporate, go in there and invest your money with capital not sort of compounding itself in terms of returns. The third leg that I was talking about, Karunya, is we're about 18 to 20 months away from a general election. So I think government spending, if anything, is only going to pick up from here. And I think this could have a resultant impact on infrastructure and cement. And I think these sectors could also land up being material beneficiaries in terms of, the fact that the Prime Minister himself has spoken about job creation. So I think there's going to be a big thrust. So I think if you focus your investments around consumption, and capex related stocks, I think you should be okay. My sense is be away from export and imported related stocks right now. That might be a little tricky if the global recession was to hit in a material and hard way.
One of the big news flow or news developments in the week gone by was tech giants either cutting or deferring their variable pay for many of their employees. Of course, it is largely to tackle their margins, but it did make investors a bit worried about what's happening. When a big company like a TCS or a Wipro, which are high quality names, when they decide to, come out in the open and say that, hey, we are going to defer your variable pay for another quarter or so. What does it mean? Because all this while, there's been this very hunky-dory, very good picture painted of these high quality tech companies, tech giants. Are there are there serious issues with respect to margins, with respect to future growth outlook? Because a lot of it hinges on the US recession, which seems still like a possibility.
So, as you were discussing, Karunya, I think the fact that you do have a genuine case of a US recession staring you, hard or soft is an academic discussion. The point I was making was that the size of the contract values allotted to the Indian companies, in terms of education, in terms of execution, they may be deferred. So the companies may not have too much of top line visibility, and it is very possible that as the fiscal year progresses, you may actually get into a situation where they revise their guidance on the top line on the lower side. At a time like this, when you are seeing wage inflation on the fixed costs and you have higher subcontracting costs and other costs that are going up, you have to find levers to cut back. Now, I don't know whether this is going to be a long-term phenomena in terms of variable pay getting cut, but these cycles happen in services businesses, Karunya. I think, you've probably had this at the turn of this century when the dot-com bust happened. You had this post-Lehman. You had this situation about 4 or 5 years back when, around the time when Demon happened, there were things that were going wrong globally globally with China as well. So I think there have been periods where IT companies have been able to find a way around it. And I think the good part about these businesses, Karunya, is even though they may pull back right now, I think there are ways to make it up. So that's the point I was making. I think I'm a little concerned about the top line growth of the IT companies because I'm not sure the TCV numbers are eventually going to translate. And there is definitely going to be margin pressure for other reasons compounded by a lower top line growth. So even though these news points are not very healthy to read, I don't know if they're necessarily long-term structural in nature. I think companies will find a way around it. And I think when times come back, they may be able to reinstate the variable pay or probably even make up for the lost time.
Okay. All right. Since we're talking about what's happening globally as well, all eyes this week have been on, the much-awaited Powell speech at Jackson Hole Symposium. What are the factors or comments or fine print that you will be looking at tonight?
So I think, Karunya, it may sound a little anti-consensus what I'm trying to say, but I think what is going to be said is probably going to be more academic in nature because I think at some level people are expecting another 50 to 75 basis rate hike. My reading is that we are probably nearing the end of the rate hike cycle in the United States. I think you do have midterms coming up in the not too distant future. You are already seeing Biden announcing student loan waivers for people under certain salary levels. So I think with the fact that you have the midterms coming up not too far away, and the fact that people are already talking about a major hard landing in the US economy, I don't think barring the next cycle you're going to see too much incremental. So I think by and large it is factored in. The US yields have also reacted. I think incrementally the commentary from here is going to shift more on growth rather than inflation. But my sense, Karunya, is that even with all the rate hikes that have happened, I don't see this being a very structural long-term recession in the US. I think the fact that you've come off a recession on the back of a pandemic where globally people have saved, that savings could provide a lot of cushion to all economies across the world. So this recession may last you 3 or 4 quarters, but I don't think this is going to result in something catastrophic in the United States by any stretch. So obviously, the bond market traders and people on fixed income will be very, very keenly watching the literature. But I think to some extent, the market knows that there is going to be another 50 to 75 basis point rate hike. And I think thereafter, everyone has sort of arrived at a consensus, at least in the market, that the focus is going to shift on growth and reviving that as opposed to just constantly raising rates to tackle a supply side inflation.
What do you think we can infer from from the jitteriness? Then yes, a lot of it is already known, significantly priced as well, and a lot of people who are market watchers have shared the same thought with us. But then, why are investors then getting a little jittery, and markets have been so range bound and so sluggish on certain days? In fact.
So I wouldn't read too much into that, Karunya. I think let's rewind back 45 days, right? I mean, how many people actually thought we'd see the kind of FII buying that the markets have seen? I don't think anyone could put a finger on it and say that this would have been the quantum of FII buying that the Indian markets have seen over the last 30 odd days. So I think the fact that the markets have rebounded in a very sharp way from almost 15 and a half thousand, you're up to about 17 and a half, 18,000. And you are staring at a slowdown. Let's not make any bones about that. So I think a little bit of trepidation is not something to be scoffed at. It's par for the course. I think, in some cases over the last 45 to 50 days, valuations have gone back, reverted to mean. In some cases, they may have gone half to one standard deviation above mean, or in some cases even higher, and people would have taken profit. So I would not read too much into short-term range-bound market movements. The fact is you've had a reasonable rally of almost 2,500 points. And if people are now sort of taking a call that this is where the markets need to stabilize, I think there's absolutely nothing wrong with that. I think the biggest positive to take away from the market, Karunya, is that the FII money is back. They are buying practically every day. And this was not something that people anticipated would happen so soon. I mean, a lot of people, us included, probably thought that this would happen closer to Diwali. But the fact that this process has already begun is probably the biggest positive I see from a long-term perspective.
Do you have a forecast for Diwali? Where do you think we could be headed by then? Or will it still be that 16,500, 17,500 range?
No, I think for the better part of the year, Karunya, probably 16 and a half, 17,000 on the way down. to about 18.5, 19,000 on the way up. I don't think there are any data points that are available to you and me currently that will help break the market out of either side of this range. I think the biggest joker in the pack is if crude goes back to 115, 120, then you probably get back into a situation where you drop to the lower end of the range. But if crude stays where it is right now, I think incrementally with FI buying, I think there is a reasonable chance that the market takes a dig at a new high at some point in the remaining 4-5 months of this calendar year.
Okay, if we look at the length and breadth of the market, broader markets seem to be showing far more agility. They have been more nimble than the index. Many of these quality mid cap names have also been making a comeback. So, do you think this could be a trend going forward, wherein the broader markets will perhaps be the big winners, the big outliers vis-a-vis the benchmark?
Intuitively, yes, Karunya. I think so. Let's put it into context, right? Let's just take a look at the domestic mutual fund industry. I think in November 2016, when demonetization happened, the size of the domestic mutual fund industry was somewhere in the range of, I think, 4.5 lakh crores. Today, just the largest mutual fund in India, SBI Mutual Fund, is at 7 lakh crores. Now, when you have the size of the mutual fund industry, which has gone from 4.5 lakh crores to almost 40 lakh crores, which is almost 10x in a matter of 5 or 6 years, all of that money cannot find its way into the Nifty. So obviously, at any point in time, you're going to have an entire basket of mid and small cap stocks that are going to land up giving you exceptional returns or even become multi-baggers. It's just about choosing the right sector and choosing some of the winning mid cap companies in them. And I think if you look at auto components, consumer durables, consumer electricals, chemical companies, certain textile companies, branded companies, quick service restaurant companies, there are a dime and dozen names available in all of these that could actually land up being multi-baggers even from here. So I think as the size of the mutual fund industry continues to grow, or even if it doesn't, even if it stays where it is, if you have a little bit of plus minus every month, I think incrementally it just makes intuitive sense that the broader markets will probably outperform the large caps for some time.
Oh, okay. When it comes to the basics of investing, most of us, I think, are on the same page where we tell our viewers, investors, that you should look at diversifying your portfolio. But right now, when a host of asset classes also are jittery, are unstable, how do you think one should go about building their portfolio if one has to do it from scratch today, or if one is entering the market today? What kind of an exposure do you have to different asset classes?
So I think where things stand today, Karunya, I think the one thing that the pandemic has done has accelerated this process of financialization of savings. I think now people are genuinely interested in investing in equities. Now, whether they do it directly or they do it through a mutual fund, an AIF, a PMS, or whatever instruments are available to them, I think there is a genuine shift in India towards equities and the equity market culture. I would say for a person, a typical person, a man or a woman in a family of four, I think at any point in time, there is no harm in having almost 60% of your savings that you're investing into equities. The balance 40% can be equally, maybe another 20-25% in real estate, and the balance 15 in commodities. You could either do it through gold and silver, or if you want to do it through agri commodities or others. But I think that will broadly be the split. You can always have some component, maybe 5% of it in fixed deposits, just from a safety standpoint, because traditionally Indians do get attracted to FDs. But I don't think you're going to get back to that regime where FD rates are going to go to 8, 9, or 10% in a hurry. I think the fact, if FD rates start going there, then obviously there's going to be some redemption in the equity markets as well. But I think that I would still say maybe about 60% in equities, maybe 20% real estate, and off the balance 20%, maybe 5% in fixed deposits or other safe instruments, and maybe about 10 or 15% in commodities, which could be led by gold and silver and maybe agri commodities.
Okay, great. Before we let you go, just one last question. Any word of advice or word of caution for new entrants into the market? Because the seesawing looks like it will continue till next few months to the end of the year, perhaps. So how to tackle that?
I would just say be reasonable and rational in your expectations, in the kind of returns that you would expect. I think from where the markets are today, if you get a 10% return on the headline index over the next 6 to 8 months, I think you should be relatively happy. I think the days of easy money are over. The Nifty was at 7,500 at the peak of the pandemic, and you went to 18,500 almost in a singular fashion. I think the easy money making time is over. There will be opportunities to make money, but don't lose your patience. Don't lose your cool if it takes a little longer than it has over the last 2.5 years. And just be a little more tempered or a little more moderate in terms of your expectations if you're investing in the market as a new investor.
All right, great, Rahul, for joining in and for sharing your advice, observation, and thoughts on the market and the big trends playing out. I'm sure our viewers are taking back lots from today's conversation. With that, guys, it's a wrap on the show. Thank you so much for tuning in. Have a great weekend.